RBC Capital Markets. Hi, Adam. Good morning.
Morning.
I mean, as Manos was telling us a couple of seconds ago, the dollar's falling all round, isn't it? So I can't really say it's mission accomplished at the weekend.
No, though I think if there's one thing you can say, it's the dollar is falling for a relatively positive reason for the global economy, in the sense that what the markets do perceive, I think, is that we've taken a small step away from outright currency wars and the negative implications that would have for global growth. Hence the risk-on move this morning, and hence the move down in the dollar. So it's not quite as negative as it might have been.
Let's be frank, though, Adam. I mean, this G20 summit, yes, they've agreed to avoid weakening currencies to lift exports. Does it make a difference?
I don't think there's anything enormously new. The rebalancing of the power within the IMF we knew was coming anyway, and I still believe that China will allow their currency to appreciate, but primarily because it's in their own domestic interest to do so, and that hasn't really changed. So as I say, I think it's a very small step. The rhetoric is positive, but not much more than that, really.
What stops the dollar's decline, Adam?
I think that what stops the dollar's decline is when the market has taken on board the move to the second round of quantitative easing in the US and the form that will take. Looking back at previous QE episodes in both the UK and the US, in fact, it's clear to me that the biggest effect comes with the announcement itself rather than the implementation of the policy. So I think what stops the dollar declining is when it's taken on board exactly what the Fed is going to do. So I think we're probably in the period of maximum weakness for the dollar at the moment.
Is that the same for sterling then? I mean, the pound's had a bit of a tough time of it lately. Manos just telling us everyone seems to be negative on it. Where do we go from here with sterling ahead of big GDP numbers this week?
Well, I think the sterling is caught in a similar debate to the US, and there's no doubt that sterling is being dragged down with the growing expectation of quantitative easing in the US is having a spillover effect into the UK. We think that the hurdle is somewhat higher in the UK. It will take substantially more bad news for a majority to favour further quantitative easing in the UK, and that should limit the downside for sterling. GDP data are important. If we see a move substantially below trend in the GDP data this week, then that move to the next round of quantitative easing would certainly be that much closer in the case of the UK. But for the moment, we think that the downside for sterling is reasonably limited from here.
What's the hot currency then now, Adam? I mean, where's all the money heading and going to be heading in the near term?
Well, my view is still a contrarian one, that I think one of the most positive stories is actually the yen, and particularly so as we head into the G20 meeting proper, and probably very limited scope for Japan to intervene. I still struggle to identify where the yen selling pressure comes from that the consensus sees driving the yen down, and therefore I think if there is a default position, if you like, for dollar weakness from here, then dollar yen lower is probably the way you play that for the next couple of weeks.
Thanks, Adam. Adam, the contrarian there. Now.